Hi and welcome to Swissquote's Daily Market Talk. It's Monday, December 23rd. I'm still here. Last week was difficult to digest but ended on a positive note still, at least for the US equity. So the US dollar looks softer this Monday morning while the US futures hint at a recovery today. But beyond tactical longs in US equities and tactical shorts in the US dollar, while the big picture doesn't really change, the Federal Reserve will certainly turn less accommodative next year, and well, that could pressure the stock prices lower and the US dollar higher. So last week was a chaotic one. The Fed's hawkish 25 base point cut, the hint from the dot plot that there would be only 2 interest rate cuts in the US next year instead of 4, because the US economy is simply too strong to continue with the interest rate cuts as previously predicted, and also the US debt limit shenanigans, even before the next US President Donald Trump takes office, gave a negative jolt to the US stock markets. But happily for everyone, things got better from Friday on as a set of US PC data came in softer than expected on Friday and somehow got some investors out there hoping that maybe, but just maybe, the Federal Reserve's got just too hawkish on inflation, which is maybe not that bad, right? Second, the US actually successfully averted a government shutdown this end of the year, and politicians there somehow disregarded Donald Trump and Elon Musk's demands for suspending that debt limit. Now, the US government will happily continue to run until mid-March next year. Then we will see what happens to that problematic debt limit under the Trump administration. My best guess is that the US will regularly continue to push that debt limit higher, as it has been doing for years, or Donald Trump will simply scrap something that didn't make sense anyway. But speaking about practice, in practice, nothing will change really. The US debt will continue to grow, and as per inflation, well, I think that those investors who got their hopes up with just one set of inflation data that was softer than expected on Friday are naive, and that the Federal Reserve will hardly cut more than twice next year if it cuts at all. Voila. And all that means that the US yield should continue to push higher, and that regardless of how dovish the Federal Reserve tries to be, because note that the US 10-year yield advanced up to 100 basis points since the Federal Reserve started cutting its interest rates back in September, and cut by 100 basis points since then in just 3 meetings. Now, around half of these cuts were probably unnecessary, and that's why not only did yields in the US continue climbing as the Federal Reserve cut its interest rates, but the possibility of a further rise in the US 10-year yield toward the 5% psychological level remains well on the table, and that's obviously not necessarily good news for the risk assets. But anyway, Friday's trading session saw a certain relief, at least in the US, because the mood here in Europe was, well, not that great at all after Novo Nordisk slumped more than 20% at the open, as the company's latest weight loss drug made patients lose less weight than the company had predicted. But I still believe that that weight loss market has ways to run higher. But anyway, across the Atlantic Ocean, the S&P 500 rebounded more than 1% on Friday, while Nasdaq 100 added 0.85%. The US yields were little changed, but the US dollar retreated from more than 2-year highs. And in the absence of major economic data this week, this Christmas shortened trading week could see a further rebound in the US equities, because no one really wants to miss this year's Santa rally, right? And also a further retreat in the US dollar in favor of other major counterparts. Yet I wouldn't just jump by my 2 feet on the softer Fed story beyond the tactical trades, of course, based on last week's softer than expected PCE data, as the core PCE in the US has been moving up since the summer dip and settled at 2.8% level for the second consecutive month in November. And I can never repeat this enough, but Donald Trump's pro-growth policies, his tariffs and his tariff threats, the mass deportation plans, everything there, hence that inflation risks are rather tilted toward the upside in the US than otherwise. So in plain English, that means that the US dollar pullbacks could actually be interesting opportunities to buy the dips. In numbers, in the euro dollar, we could eventually see resistance forming between the 105.45 area, so between a psychological level that's 105 and the minor 23.6% Fibonacci retracement on September to December decline. In cable, 128.20 area should limit the upside potential unless there is an unexpected narrative change for the UK economy. For now, remember that the story remains the same. The Brits will likely feel the pain of higher taxes before enjoying the benefits of higher government spending next year. So, data-wise, released on Friday, the latest retail sales data from the UK came to support that view. In Japan, while the dollar-yen's way is quite cleared for a further advance toward the 160 psychological mark until the Japanese yen bears get scared that the Japanese authorities will finally intervene directly in the FX markets to stop the bleeding in the Japanese yen, because the Bank of Japan will unlikely to make any changes to their rate policy until March or even April next year, because this is pretty much when the Japanese policymakers think that they will have a clearer view, a clearer picture on the potential and the impact of Donald Trump's international policies and his tariff threats. In Canada, the loonie is taking a breather right now on the back of a broadly softer US dollar, but the political shenanigans in Canada keep the risk tilted toward the upside in the dollar CAD, as calls for Mr. Trudeau to step down are mounting these days. And finally, the Aussie dollar is forming a support near the 62 cents level. The pair is right now oversold, but buying the Aussie against the US dollar looks similar to try to catch a falling knife these days, especially since September. In the commodities space, well, the US crude is better bid this Monday morning above the 50-day moving average. That's just below the $70 per barrel psychological level, but without a strong conviction to extend this rebound higher. The price rallies in oil will likely see resistance into the 100-day moving average. That's near $71.40 per barrel level and declining, and into the $72.85 per barrel level, which is the major 38.2% Fibonacci retracement on late summer slump that should distinguish between the negative trend building since then and a medium-term bullish reversal. The ongoing narrative of weak and weakening global demand and ample global supply should actually maintain oil prices in the bearish consolidation zone for now, with, however, a limited downside potential seen near the $67 per barrel level that's been acting as quite a solid support since the end of September. In precious metals, gold is better bid this Monday morning. The yellow metal is pressured by the rising US yields these days that increase the opportunity cost of holding the non-interest bearing gold. But note that an accelerated sell-off that we might see in global equities could eventually drive capital into the safe haven metal, regardless of the yields and how high they go in the US, while copper futures see some support near this year's ascending channel base, and they're standing at quite interesting dip buying levels right now for those investors who are betting that the red metal has quite a nice upside potential for next year on the back of improved global economic outlook thanks to softer monetary policies in many locations around the world. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope This episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.